I made over $260,000 this year, which is in 2024, using this one simple trading strategy. Before you doubt it and start questioning it, let me show you guys some of my biggest payouts that I got this year using prop firms. All right, so we're on my phone right now and we're on Wells Fargo, which is the bank that I use to get all of my payouts from Apex. And as you guys can see right here, we have about $80,000 worth of payouts in page one. As you guys see, we have $20,000 for the month of December, another $20,000 worth of payouts for the month of November, another $20,000 for the month of October, and another $20,000 for the month of September. As the pages go on, we have more and more payouts, adding up to about $260,000 worth of payouts over on Wells Fargo. And if you're trying to trade futures and get these payouts exactly like how I am, then I highly suggest using the Apex Trader Funding prop firm, as it's one of the best ones in the game right now. Click the second link in the description and use code BLASTERS to get up to 90% off any funded account and start getting these payouts. Now, before I break down and expose the six-figure trading strategy, if you're interested in trading live with me, and by live I mean my entire screen being shared with live executions, then click the first link in the description and join my community there. By the way, don't tell anyone, but if you use code STRATEGY at checkout, it'll apply 50% off any premium upgrade for your first month, so you could trade and make money with me using this simple trading strategy. Now, let's get to breaking down this strategy. All right, so now that we're finally on the charts, let's go ahead and get started to break down this trading strategy. Now, there's only 4 things that you need to know to actually get these trades very consistently. That being the trend, the drawn liquidity, the MSS, and an FVG. Now, I know it might sound like Chinese to you guys right now, but it's actually very simple. And by the end of the video, you guys will completely understand this, as, like I said, it's completely simple. So let's go ahead and start with the trend right here. Obviously, I'm sure we all know what a trend is. It's very simple, actually. It's just when the market is either going up or going down in a very steady rate. So in this case, let's go ahead and say that the market is looking like this, for example. Obviously here, we know that the market is in a very clear bullish trend, but the real question here is why is it in a bullish trend, or how do we know exactly that it's in a bullish trend? Obviously, we can say that the market is just going up, but that doesn't really say that the trend is bullish. Pretty much when a trend is bullish is when the market is constantly creating higher highs and higher lows in the price action. Here's what I mean. So obviously the market here is going up, but in this case, you guys can see right here that the market has a main low and a main high. That's what we're gonna label it as right now, right? So I'm gonna write down here main low, which is going to be this low right here, and we also have a main high right here. I'm going to go ahead and put it to the side. Now, when the market is constantly going up, it's going to have these pullbacks. Obviously, in a bullish trend, the market is not always going up. And what I mean by that is that it's not only going to be green candles. Obviously, in a bullish trend, there's going to be red candles, and there's also going to be a lot more green candles, since the market is obviously in a bullish trend. But in this case, what I mean by this is every pullback that the market has, when the market is creating a higher low pullback, which I'm going to show an example right now, that pretty much means that sellers are trying to step in, but they're just not as strong as buyers are, right? So in this case, we have the main low, we have the main high. The market pushed up, had a pullback, which is right here from the push up, right? We had a mini pullback, right? We created a lower high, and we went ahead and went higher into this higher high. So as you guys can see right here, the market has a pattern of creating these lows and these highs, and every high and every low is going to be higher and higher and higher, pretty much confirming that the trend is bullish. And like I said, it's simple science here, but it's very important to know because some people actually get it confused, right? So once again, let me go ahead and label it right here. You guys see that we have a higher low right here. As you guys see, we have the main low, market pushed up, pulled back, created a higher low, pushed even higher, creating a higher high right here, higher high, and the market had one more pullback, created a new higher low right here, right, and pushed even higher to create a new higher high, right? So you guys can see right here, there's a pattern in the market where the market keeps creating higher highs and higher lows. Everything starts with higher, right? That means that the market is in a confirmed bullish trend. Obviously, the market can't just be going up and you label it as bullish. You need to have your confirmations behind it. The confirmations in this case, your higher highs and your higher lows. Now, it's also vice versa in a bullish trend, which obviously I'll show an example just so you guys don't get confused. So for example, we're in a bearish trend. What does a bearish trend look like? Well, it's very simple. The market is steadily just going down. By going down, I don't mean every candle being a selling candle. What I mean is that the market is in a steady run to the downside with all the selling coming in. Let me show you, right? So for example, let's say that we created a high up here, right? And the market is just selling off like this. Now, in some cases, it might be straight selling. In some cases, it might be a very slow grind down, or in some cases, it might just be a very clean type of price action where it looks like this, for example. So how exactly do you confirm that this trend is actually bearish and not just chop in the market? Well, let me show you guys. So the trend starts up here. So we're going to have the main high up here, and we're going to go ahead and have the main low right here. So we're going to label this as the main high, and we're going to label this one as the main low. Now, as the market continues to go down, it's going to start creating these patterns where it's known as, instead of a higher high and a higher low, since we're going down, we're going to be creating lower highs and lower lows. So with us having this main high up here and this main low down here, the market had one small pullback to the upside, which is buyers trying to step in, but buyers in this case don't have the strength that they need to completely flip the trend. That's where sellers step in and pretty much sell it off completely. So what this high up here is known as is a lower high, right? So we're gonna go ahead and label this as the lower high. Once the lower high failed to be created with buyers being very weak, the market sold off and created this lower low, confirming the bearish trend so far. So right here, we're gonna go ahead and label this main low right here as a lower low. And as you guys can see right here, the market pushed up one more time, found this high once again. Sellers took complete control here and they created a lower high. Once again, buyers tried to step in after this pullback. They failed to step in, sellers took control and created a new lower low. And the cycle just goes on and on. So this is exactly how you guys can be able to identify trends in the market, by actually identifying it with actual confirmations, right? Instead of just looking at the market and just being like, oh, the market's going up, we're in a bullish trend. You guys need confirmations to make sure that everything is confirmed and A+ ready so you can trade it, right? So in this case, once again, we have the lower low, we have another lower high right here, and the case just goes on and on until the trend flips. So now that we have the trend, which is step one of the 4-step strategy, now that we have that completed, let's go ahead and review DOL, what it is, and exactly how you can use it to your advantage to start making money in the markets. Now, this one, you guys have to kind of be paying attention here, because I could lose you guys here. It's very simple, but it can also get very confusing. So let's go ahead and get started with drawing liquidity. So what exactly does DOL stand for? Now, I just said it a second ago. I don't know if you guys are paying attention. That's just me putting you guys to the test. What DOL stands for is actually draw on liquidity. So the D obviously stands for draw, right? So here, let me go ahead and put draw. O stands for on, obviously, and then L stands for liquidity. So what exactly is drawn liquidity? If you guys are somewhat new to trading, maybe like a month in, maybe 2 months in, or whatever, or maybe 10 years in, I'm sure you guys have heard of the strategy called support and resistance. Everyone knows about this. It's pretty much the market makes a low or a high, and you use that to find levels or a breakout or a reversal and stuff like that. It's very, very simple, and every trader knows about it. Even if you're brand new or not even a trader in the market, you guys might know about support and resistance. So we actually use the liquidity made in the support and resistance levels to our advantage with the banks. Now, let me show you guys what I mean with the banks. I actually trade using this concept. You're going to be trading with the banks, and not literally, but it's a concept pretty much. Let's say, for example, the market is in a bullish trend. So let's say, for example, right here, the market is currently going up, creating these lows, creating these highs, creating these lows, creating these highs. To a regular trader, to a retail trader, these lows and these highs will be marked as support or resistance, and resistance. Let me redraw this real quick so I can give you guys a better example on pretty much resistance, for example. So let's say, for example, the market is in a bullish trend, and we created this high up here where buyers they're struggling to break above, right? And out of nowhere, pretty much sellers just take complete control. So what ends up happening right here, what the market ended up creating is a very nice resistance level right here where price just simply can't get above. So we're going to type this as resistance, right? As price, it just can't break above it. To the retail traders, this is known as resistance. To us trading this strategy, this is known as liquidity in the market. Let me explain to you guys. So in this case, what ended up happening here is obviously everyone in the world trades with a stop loss. If you don't know what a stop loss actually does, what it does is when you place an order in the market, obviously you need a place to sell if the trade goes against you. You're not going to be gambling the trade and holding it till zero. I hope not. But pretty much everyone trades with a stop loss in the market. Finding a stop loss in the market, typically people use highs and lows, as it's where price either bounced from or rejected from, and it's where buyers or sellers pretty much stepped in from, right? So in this case, let's say, for example, we're looking at this resistance level. In this case, the market ended up selling off, and obviously when the market starts selling off, everyone is going to start looking for shorts, as that's what pretty much the trend is in the market. So in this case, let's say, for example, we're pretty much a retail trader. In this case, we're looking to take shorts off this this small support line right here. When we place our order, we're going to be targeting everything down here, for example, and where we're going to be placing our stop loss is going to be placed at this resistance level, as it's where we know buyers just can't break above, right? And if we know that buyers can't break above this level, we're pretty much placing it at this level, pretty much telling the market like, hey, if price goes above this level, I want you to stop me out and sell my order over to somebody else. Now, one thing that you need to understand in the market is the market moves with buyers and sellers, bid and ask. So when you're placing a stop loss in the market, when or if you get stopped out, you're pretty much giving your contracts that you bought over to someone else at a discounted price. So pretty much where there's a loser, there's a winner. Where there's a buyer, there's a seller. Where there's a seller, there's a buyer. And that's where this bank concept comes along. You guys know our money in the market, the retail money, really doesn't do anything, right? We trade maybe with $100, 500, maybe 1,000, maybe even $10,000 at most, right? Maybe more, who knows? But you guys need to understand that trillions upon trillions of dollars in the market is moved around every single day. So if you really think about it, $100 in the market, or maybe $1,000, or maybe even $10,000 in the market, it won't even move a decimal. You guys need to understand that. So the big people here are the banks, the institutions, and the hedge funds that trade with millions, maybe even billions of dollars in the market. But the problem is they can't just create orders out of thin air, right? Remember what I said, where there's a seller, there's a buyer. And now that we know that the banks have all the money, obviously they have the power to manipulate the market. And with them being able to manipulate the market, there's algorithms, pretty much computer-based trading, that can read where a lot of liquidity is made, known as drawn liquidity, and pretty much just take out these orders, stop everyone out, have them sell their contracts over to the banks, and once the banks buy it, they are able to do the big move, so they make the money and you lose the money. So let me explain this in a pretty clear example on the chart, right? So for example, let's say that a lot of traders see that price is struggling to break above this resistance level, right? And out of nowhere, it starts selling off. Now that it's selling off, you and I, or maybe a lot of people, we start entering shorts, right? We start entering, if you're doing options, we're doing puts. If you're doing futures, you're doing shorts. If you're doing Forex, I'm pretty sure it's shorts or sells, right? We all start entering sells. And obviously when we enter, we're gonna go ahead and place our price targets, and we're gonna go ahead and place our stop loss. In this case, our price targets is gonna be, it could be any of these, and our stop loss is gonna be where price is struggling to break above. When so many people do this, what happens is we create a pool of liquidity, pretty much a certain level where a lot of orders are placed at. Pretty much meaning, if we enter this position, we're telling the market like, hey, if we break above this level, I want you to sell my contract over to somebody else. And when a lot of people are doing that at the same level, these algorithms that can pretty much calculate math and see where all the orders are, at least that's what the concept is, it reads all of these orders at certain levels, and that's pretty much us giving them money. That's pretty much us saying, hey, take my money, right? Let me explain to you guys. Has there been a time where you guys place a trade, it stops you out to the point, and then it starts going your way straight into your price target? Pretty much what happened there is you got swept and you guys were liquidity, right? So I'm gonna show you guys a clean example on how this looks like and how you guys can avoid it and actually use it to your advantage. So in this case, resistance right here. Draw on liquidity. We're not using support and resistance. We're actually using this to our advantage thanks to the retail traders, right? So to us, price struggling to break above these levels is not resistance. It's actually drawn liquidity. So we're gonna go ahead and label this as DOL. So instead of us playing with the retail, we wanna be playing with the banks. Here's what I mean. Now, as the market is selling off, obviously the banks are not gonna allow the market to sell off because banks are the ones that want to make the big money in this entire move. All they're doing is they're waiting for the retail to create the liquidity at this high up here so the banks can manipulate price to shoot back up into this resistance, stop everyone out, and by everyone, I mean everyone. They're gonna make sure every level of liquidity nearby gets taken out, right? And by level of liquidity, I mean everyone with the stop loss in the market, they get stopped out, and when they sell their contracts over to somebody else, the banks are buying it in this case. Once again, we have a bunch of stop losses placed at this resistance level before the big move down. Banks buy this up, manipulate price, stop everyone out, maybe you, maybe me, and then once all of us sell our orders over to the banks, they're satisfied and they start making price go all the way down into what you thought was your price target. Instead, you got stopped out before the trade even did anything. So pretty much what ended up happening here is like this. And it's happened to you, it's happened to me, it's happened to everyone, right? We're all a victim of it. We were once liquidity and it just happens. But pretty much what this is known as is a DOL sweep. So this is step 2 of the 4-part strategy. Pretty much right here, we have drawn liquidity, we took out drawn liquidity, we got a DOL sweep. Pretty much price is sweeping all of the orders. The sellers are selling it over to the banks, so the banks can get filled at the absolute top and just make this go all the way down so they can make as much money as possible. All right, so now we're gonna start going over to step number 3, which is MSS, right? So what exactly does MSS actually stand for? Well, let me show you guys. So MSS stands for Market Structure Shift. So what exactly is a market structure shift? In simple terms, it's pretty much just when the trend in the market flips over. Obviously, the market doesn't always go up and the market always doesn't go down. Stages to the market as the day goes on. Sometimes the market is only going up, sometimes the market is going up, then going down, then going up, or the cases can go on and on. Pretty much what MSS means, pretty much just changing the trend, right? It can go from going up to going down to going up. Why exactly do you need to know this? Obviously, we all know that the market doesn't only go up, nor doesn't only go down. But actually, we could use MSS to our advantage to know exactly when the market is going to go down and when the market is going to go up, and how exactly we can use this to our advantage to make money in the market by sniping the bottom and even sniping the tops. So we're going to go ahead and do this by mixing both drawn liquidity and MSS. So in this case, let's say for example, the market is in a very bullish trend. So step one of the strategy is identify the trend. In this case, we know that the trend is bullish because the market is creating higher highs and higher lows, right? So as you can see right here, we have the main low, we have the main high, we have a higher low, we have a higher high, we have a new higher low right here, we have a new higher high, and so on. So in this case, you guys can obviously see the market is in a very, very nice bullish trend. As the market is going up, obviously retail sees the market going up, people get FOMO, they start getting in and they start placing their stop loss in the market, right? So in this case, what we could do here is we're going to start finding our levels of liquidity, which is step 2 of the 4-step strategy. So in this case, since the market is in a bullish trend, we're going to be ignoring the highs in this case, right? So we're going to delete these higher highs as they're not really too important. Keep in mind, we're paying attention to the DOL in this case. The drawn liquidity here is going to be every single low that the market makes as people buying in as the market is going up. They're going to be using every single point of interest where the market is bouncing from as their stop loss. For example, let's say that the market is going up and we identify the market is going up very strongly right here. So what we're going to be doing is we're going to be waiting for the market to pull back, find the bottom, and push back up. Once we identify that the market is pushing back up, we're going to go ahead and enter our long position. And when we enter our long position, we're going to be placing our stop loss at the nearest bounce as that's where buyers most recently stepped in from. And now, keep in mind, a lot of retail traders are doing this. So when we place our entry, for example, let's say that we entered right here, we're going to be placing our stop loss right here. Now, keep in mind, guys, everyone has the same market. So when people are looking for longs, they're seeing the same exact bounce as you guys are, and they're placing their stop loss at the same exact point. Now, if you guys were paying attention, you guys will know that this creates liquidity in the market, which is what banks are hungry for. When a lot of us are placing our stop loss right here, or it could be down here, for example, or it could be the main low, for example, what we're doing is we're creating liquidity for the banks to go ahead and take out. Remember how I told you guys that the market goes up and down? For example, in this case, the whole reason the market is going up is probably to take out some drawn liquidity that I had to the upside to go ahead and take out those orders, the banks get filled, and then they start going down. So for example, let's say that we had drawn liquidity, for example, around up here. Let's say, for example, the market found a high up here. Pretty much what the whole reason it's going up is to take out this liquidity right here. So we're going to label this as DOL right here. Right? So we have drawn liquidity right here, right? The market just took it out. So how exactly are you able to find the MSS in the market and know exactly when the market is going to reverse and start going down? Well, we're using the DOL to our advantage once again. Remember, guys, so now that we have drawn liquidity right here, pretty much what's happening is when the banks take out these orders right here and it has no more room to go higher, or it's not really interested in going any higher because there's no more orders above that exist that the banks really want to take out right before they make the market go down. Once every level of liquidity gets taken out, what's going to end up happening is the banks, they're going to go ahead and stop everyone out that had their stop loss set at this drawn liquidity, and they're going to start making the market go down. The pattern in this case is the market is creating higher highs and higher lows until it takes out drawn liquidity to the upside. Once every level of liquidity gets taken out, what's going to start happening is the trend is going to start flipping and the pattern is actually going to start moving down. So the pattern in this case is the market is in a bullish trend, the market is creating higher highs and higher lows, it takes out drawn liquidity, and now the market or the pattern is creating lower highs and lower lows. Pretty much meaning that the market is going from a bullish trend and is transitioning over to a bearish trend after every single level of liquidity to the upside got taken out. Right now, once the MSS starts forming, so in this case, what an MSS would look like would be like this. For example, the market goes from creating a higher high or higher low into creating lower highs and lower lows, or it could be vice versa if the trend started off as bearish at first. So in this case, you guys see right here, we have an MSS model right here, right? Once again, the market went from creating higher highs and higher lows into taking out drawn liquidity and started creating lower highs and lower lows. Now, as the market is going down, keep in mind, guys, as the market was going up, we created drawn liquidity. Remember, every bounce that we have is going to be one of your price targets if you're going to enter shorts up here. PT1 will be right here, which stands for price target. We have PT2 right here, for example. We have PT3 right here, and we have the final price target, which is PT4. And why exactly are you using these levels as your price targets? Well, it's very simple. Remember guys, every high and every low, depending on the trend that the market creates, is known as liquidity in the market, right? The stronger the bounce, the stronger the rejection, the more orders there are in the market that the banks are hungry for. Now the banks took out every level of liquidity to the upside, they're not as interested in making the market go any higher. They're actually interested in taking out the remaining liquidity that they made on the way up. So in this case, now that every level of liquidity to the upside got taken out, they're going to be more interested in taking out the liquidity to a downside. And now that you know that every level of liquidity to the upside got taken out, you're going to start having a bearish bias. You know this because the banks, they're the ones that move the market here. And now that we know that the banks don't have any reason to make the market go up, they're going to start making the market go down, right? So once you find an entry for shorts anywhere in this case, you're going to be using every single high or low that the market created as your price target, as we know that there's a lot of stop losses in every single point of a bounce here in the market. In this case, if you entered shorts, let's say for example, if you entered shorts right here, right, you place your stop loss at the complete top, right, and then you target every single price target down here, or every single low that the market created as a price target. And that pretty much sums up what an MSS is. It's just pretty much when the market flips from bullish to bearish or from bearish to bullish. Now let's go over to the final step, which is going to be the cherry on top, which is an FVG or an IFVG. Let me explain to you guys. What exactly does an FVG stand for? Well, it's actually really simple. Now, what an FVG stands for is actually a fair value gap. Now, it's very simple to understand in the market and it's actually really easy to find, but there's a few rules that you guys need to understand to find the perfect fair value gap, to find the best entries in the market once you have all your final 3 confirmations lined up in the market. So once again, what an FVG stands for is a fair value gap. Right now, you guys might be familiar with gaps in the market, but what an FVG is not any of those gaps. Let me explain to you guys. I'm kind of going to be drawing out an example of a chart, and I'm going to be showing you guys exactly what a gap looks like and exactly how you can use it to your advantage. Pretty much what a gap is, I'm going to go ahead and edit all of this and show you guys. Okay, for example, let's say that the market is in a bullish trend. Of course, you guys know each and every single candle has a different size, a different amount of volume, and a different amount of interest. So in this case, let's say for example, this candle, you know, it's a normal buying candle. And then this candle, for example, is a very abnormal candle, right? It's huge, it's bigger than the rest, and you know, it looks very, very strong. Now, what a fair value gap is in the market is it consists of one thing and one simple thing. This is known as an imbalance in the market. Pretty much when all of the orders inside of this big candle didn't get filled. Now, when orders don't get filled in the market tends to retrace back into the price where the orders didn't get filled and start going back up to where it was originally headed. So in this case, the way you find fair value gaps is obviously identify where the big candles are. In this case, obviously we have 2 normal candles and we have one very, very big candle, which is this one in this case. The only thing you guys are going to do is you're going to find the complete top of the candle and the complete bottom of the last candle, right? So what you're going to do here is you're going to mark out the top of the first candle, right, which is going to be like this. You're going to go ahead and mark out the bottom of the third candle, which is going to be like this, for example, right, which creates somewhat of a gap in the market. So now you're going to go ahead and mark out the middle of the candle. And in this case, you now have an official fair value gap. But don't get too ahead of yourself. There's a few rules that we're missing here that actually makes a fair value gap perfect and very likely to play out in your favor. So the one rule I look for when I measure out fair value gaps, that these candles are at least 40 points and above. So what exactly do I mean being 40 points and above? Well, it's actually very simple. Now, if you guys are trading futures, you guys know that we don't trade based off the dollar amount. We actually trade based off the ticks and the point amount. When we're looking for a candle, we're making sure that each and every single candle is about 40 points to make a valid fair value gap. So in this case, for example, you guys are going to go ahead and grab the ruler right here, and what you're going to do is you're going to grab the candle from the complete bottom to the top and make sure that the number says 40, or it could be 40 and above. So what we're going to do here is we're going to grab the candle from the complete bottom, right, measure it all the way up, and in this case, or in this example, this candle is about 121.25 points. So obviously this makes for more than a valid fair value gap, which is amazing. The second rule when you're finding these fair value gaps is you need to make sure that these candles are full candles. You can't be trading candles that have a ton of wicks or any of that stuff. You need to make sure that at least 90% of the candle is a body and not a wick. What this means is that there's active price action and not just price action that was a thing back then. No, you need to make sure that price is valid right now and is currently active and it has not been filled So in this case, yeah, we have about a 121 point candle right here, which makes for a fair value gap. There's one more rule that I look for because I know a lot of you guys might be trading NQ or ES. Now, if you guys know me, obviously you guys know I trade NQ and only NQ. But if you guys are trading gold, ES, or NQ, there's a bit of a point difference here that you guys should be looking for because obviously each and every single one of them has a different point range, right? So let me go ahead and break it down right here. For example, if you're trading NQ, obviously we just reviewed NQ, anything above 40 points is a valid fair value gap. Now, if you're trading ES, for example, anything above 10 points is a valid fair value gap. Now, if you're trading gold, anything above 4 points is a valid fair value gap. So if you guys want, go ahead and feel free to screenshot this. And when you guys are in the market looking for fair value gaps, once again, make sure the point system is aligned, and you guys need to make sure that each and every single candle is a body and not a wick. At least 90% of the candles should be a body, and it should be at least any more than these points right here. How exactly do we use fair value gaps as entries, and how do we use them to our advantage to trade into drawn liquidity and grab the perfect move in the market? So in this example, let's say that the market is obviously in a bullish trend because we have a lot of buying coming in. Now, in this case, let's say that we have drawn liquidity up here, for example. So in this case, since the market is in a bullish trend and we know that we have drawn liquidity to the upside, we're going to be targeting the drawn liquidity up here. But how exactly do we know when to enter? Well, like I said, when the market has an imbalance, which is also known as a fair value gap, and it's anything more than 40 points, if you're trading on NQ, for example, what we're looking for is for price to retrace back into the gap, fill all of the orders that never got filled. Once those orders get filled and we start seeing more buying coming in, that's going to be our cue to go ahead and take the entry. Why? Because we're entering at the complete bottom after a perfect retracement. So in this case, let's say, for example, we have, the bullish trend, we have a lot of buying coming in, the market has a mini pullback, right, go straight down into this fair value gap. What you're looking for when the market goes inside of the zone is you want to start looking for any point of a bounce. The market could bounce off here, the market could bounce off the midpoint, or it could even bounce off the complete bottom. As long as this gap, right, as long as price does not go below this gap, you should be good to go as a valid fair value gap. Once the market starts bouncing up once again, that's going to be your cue to go ahead and start entering your long position and target drawn liquidity above. Let's say, for example, price is in a bullish trend, it starts rejecting back down, goes inside of the fair value gap, and you start seeing a lot of buying start coming in. When you start seeing that buying coming in, you're going to wait just a tiny bit, make sure that the buying is confirmed and it's not a fake out. Let's say, for example, price goes like this. Once you start seeing price move like this, you're going to start looking for your long position off anywhere where price is. You're going to place your stop loss at where the market just bounced from, which in this case will be right here, and your price target will be drawn liquidity above. So in this case, you're looking at a minimum of a 1-to-2 risk reward ratio trade. And long story short, how the trade should look like should be something like this, straight into your drawn liquidity. This is known as a fair value gap retracement, and it's what I use to go ahead and take these moves by identifying the trend, the drawn liquidity, and pretty much taking this into drawn liquidity. So now let me show you guys what an IFEG is, because it's actually a game changer. Pretty much what an IFEG is the same concept as a fair value gap, but instead of looking for a bounce, you're looking for an inverse of the fair value gap. Let me show you guys. Right, so we're going to be using the same exact example because it actually plays a big role with this example. So we're going to be using this one simple bullish fair value gap right here. And now that we know that banks took price into drawn liquidity and took out all of the stop losses in this drawn liquidity, it doesn't really have any reason to go any higher since banks already got filled at the complete top. So now you should start expecting price to start shooting down, right? This is known as an MSS model. Very simple. So for example, let's say price hit the drawn liquidity and you start noticing a lot more selling coming in right after the bullish trend pretty much ended, right after taking out drawn liquidity. Now you start noticing a lot more selling coming in. What is this right here known as? Well, the market went from creating higher highs and higher lows into creating lower highs and lower lows, as you guys can see right here. So what this is known as is an MSS model, right? So we have an MSS right here. So we have drawn liquidity right here. We have a DOL sweep forming right here. Once all the stop losses got swept and taken out, we're going to start noticing a lot more selling coming in. So we have a DOL sweep right here where price swept from, and now that price is rejecting back down, we're forming an MSS model, right? So we have all of the confirmations in the chart pretty much telling us like, hey, we want to start going down, but going down into where? Well, we want to start going down into where the market actually bounced from. And in this case, the market actually started the trend down here. So where drawn liquidity is lying in this case is going to be at the complete bottom down here. So we're going to label this as DOL/PT, which stands for price target. Now that we have a bullish fair value value gap right here. We're not really looking for a bounce, we're actually looking for shorts. What we want to start looking for here is actually a rejection of this fair value gap and actually inverse it so we can start taking shorts. So the way this should look like will be somewhat like this, right? So price starts rejecting all the way down. We look to inverse this fair value gap. Once price goes below the fair value gap, that's going to be your cue to go ahead and enter shorts and target the nearby liquidity. In this case, will be right here. Obviously, the risk reward would be a lot better. This is just because I drew out the example and, I didn't really think about it, but this is how the trade should look like. You look to enter shorts right here, you place your stop loss anywhere like this, and you just target drawing liquidity like this. And the way the trade should look like will be somewhat like this. This is literally the model that I used all year, and I want you guys to go on the charts and start looking for this model and see how consistently this actually works. And I want you guys to actually put it to the test and see if you guys can make money. Now, if you guys did learn something new from this video and you guys maybe might have made money off this video, make sure to like, subscribe, and maybe even comment how much money you guys made or any questions you guys have from this strategy. I'll be sure to answer it for you guys. Now, I'll see you guys in the next video.